Before we get to that and more, a quick check of the day's market action, where the Dalal Street failed to hold on to the highs clocked in early trade, closing near the day's low. So the Sensex slipped 246 points from the day's high of 41,185, and the Nifty gave up its hold over 12,100, both the indices ending in the red. The broader markets underperformed and also closed the day in the red. Except the IT index, all the sectoral indices ended the day in negative territory. Well, the big story that we've been tracking, the GST Council is scheduled to meet on Wednesday to take stock of the bottlenecks that have taken a toll on revenue collections. According to the agenda note for the meeting that has been accessed by CNBC TV18, the Council will take cognizance of falling revenue levels and its deviation from the revenue neutral rate. Remember, the average GST rate is currently 11.8%, whereas the revenue neutral rate required to meet targets is 14 to 15%. Ahead of that crucial meeting, the centre has cleared the GST compensation of over 35,000 crore rupees to states and union territories for the months of August and September. Remember, the centre has been facing heat from various opposition-ruled states over pending GST compensation. Earlier this month, finance ministers from Punjab, West Bengal, MP, Delhi and Kerala had met with the Union Finance Minister, urging her to clear their compensation as soon as possible. The states complained that they were facing acute fiscal pressure due to the delay. The centre usually pays GST compensation to states in bi-monthly instalments, and instalment for the period of August to September and October, November were pending. The release of 35,298 crore rupees comes just hours after CNBC TV18 reported that states had urged the finance minister to table the compensation issue as item number 2 in the agenda for the GST Council meeting. Remember, CNBC TV18 had also reported last week that the centre has only 46,649 crore rupees in its compensation kitty for cess collections until November. Well, ahead of the GST Council meeting, West Bengal Finance Minister Amit Mitra has written to the Union Minister Nirmala Sitharaman raising several concerns. Timsy joins us now with more. Timsy, take us to the key issues raised by Amit Mitra.
Well, yes, according to the letter that West Bengal Finance Minister Amit Mitra has written to Union Finance Minister Nirmala Sitharaman, he has very clearly cited that the current review of items under the GST exemption list for shoring up revenues is alarming, and government should not get into setting such a precedent for the council. Also, what he has stated that the current list of exemption is actually integrally connected with the daily lives of the common man, and also any tinkering would lead to undoing of the hard work that the council has done in the past while setting up the rates, while setting up what could be the exemption list even before the rollout. Also, with respect to the hike in GST from 5% to 6% or any other from 6 to 8%, he has said that this move will hugely be inflationary and further worsen the macroeconomic situation for common consumers. He has also said that imposing cess on luxury items which were reduced from 28% to 18% or are still under the 28% bracket and do not have a cess right now, this move will be highly regressive. He has also said that this will start a dangerous trend of imposing cess as and when the government feels that the revenues are declining, and this should not be exercised in desperation. Now, he has also said that any tinkering with GST slabs and items during these difficult times of macroeconomic situation would be highly detrimental and hugely counterproductive. He's also said, and I quote here, the solution of additional resource mobilization lies not in tinkering of rate structure, but lies in focusing on anti-evasion and fraud detection. So he's given the solution also. He's also pointed out that the measures that the government has been considering, which is widely reported in the media, is actually counterproductive. Let's see what happens when they meet in the council meeting on 18th of December. Back to you.
All right, Timsy, many thanks for joining us. Well, in fact, the finance minister speaking earlier this morning did suggest that there hasn't been enough discussion on changes as far as rates are concerned or slabs, so maybe suggesting that a decision on the 18th of December is unlikely. It may take a while before there is a decision on actually moving on rates. Now, the chairman of the 15th Finance Commission has called GST revenues the most important elephant in the room. Speaking to the media at North Block in the capital, N.K. Singh said that the Finance Commission will look at the tax regime very closely to figure out measures to boost revenue and to make GST stakeholder friendly. He went on to add that there have been one too many swift changes on the GST and that the regime needs predictability and certainty. The Finance Commission chairman has also mooted the idea of an incentive structure for GST compensation to states instead of a promised rate. While India's economic growth slowed to 4.5% in Q2, hitting the slowest pace in over 6 years, and now ratings agency Moodys has lowered its FY20 GDP growth projection for India from 5.8% to 4.9%. Moodys believes that the slowdown in the Indian economy, which was earlier investment-led, has broadened into weakening consumption. Ritu Singh joins us now with the details. Ritu, take us through the other key takeaways from Moodys.
Moodys has lowered India's GDP growth forecast for FY20 to 4.9% from 5.8% seen previously, as it says that what was once an investment-led slowdown has now broadened into a weaker consumption pattern because of three key reasons: rural financial stress, low job creation and liquidity constraints. And what has made all of this worse is the continuing credit crunch at the non-bank financial companies. Whatever steps the government has taken to arrest the downfall in this economic activity, they will only have a very limited impact, is what Moodys says. Now, these steps include, income support for farmers, monetary policy easing, as well as corporate tax cuts. What Moodys does say that there will be somewhat of a revival next year, but the growth that we'll see will be nowhere near the growth levels that we've seen in the recent past. This will, of course, in turn have an impact on the earnings on the auto sector. But what is worse is that it will also impact the household income and savings. That in turn could worsen the asset quality problem for retail loans, especially at private sector banks.
All right, Ritu, many thanks for joining us. That's Moodys cutting its growth projection for India. Meanwhile, in stock-specific action, JSPL slipped in trade after the coal ministry clarified to CNBC TV18 in an exclusive that the allotment of the Gare Palma coal mine to the company has not been approved in public interest. CNBC TV18 received the clarification exclusively from the coal ministry. Nigel joins us now with the details. Nigel, a setback for JSPL.
Well, that's right. We are at CNBC TV18. We were the first ones to get this communication coming in from the coal ministry. They told us that the allotment of the Gare Palma 4x1 coal block to JSPL has not been approved in public interest. Now, this is the first official, communication that we're getting from the coal ministry. If you just take a look at the stock, in the last 15 days or so, the stock was at around 160 rupees. Then it was getting a little bit nervous because we have had two notifications coming in from the Ministry of Coal in the last 15 days or so. And both of them indicated, but they didn't say outright that, it's not going to be approved. So the street was bracing for this bad news. In the last couple of days, the murmurs got even louder that, in fact, yes, this could be a possibility that JSPL will be not getting this coal block. To give you a few details, the reserve price for this coal block was at around 150 rupees odd. JSPL, they emerged as one of the strongest contenders for the block because their bid was at around 230 rupees per ton, and the auction got closed out at that price. However, in 2015, we had the Vedanta group that had bid for this mine at around 1,585 rupees per ton. So could be that pricing has played a bit of a spoil sport, but as of now, we have no confirmation. Why is this block important for JSPL? Because if they got the block, their EBITDA number could get bumped up by 500 crores to around 900 crores odd. A negative coming in there, and we are at CNBC TV18 were the first ones to hear from the coal ministry in terms of JSPL not getting the approval for this coal mine in public interest.